Morning, ladies and gents. My name is Simon Brown, doing our Friday focus on funds. We're going to be looking today at exchange-traded funds, in particular, a lot of requests for healthcare funds. So that will be our focus. It does mean we're looking offshore for healthcare funds, but I'll get to that in a moment or two, and we can go into the details around that. You got questions? Drop them into the Q&A box. I'll get to the questions at the end, unless they're time specific. But this is about a 20-minute presentation. We'll have lots of time for questions thereafter. Looking at healthcare broadly, there are a couple of sort of major segments to it. And the first, obviously, is the hospital groups. Those are companies which are predominantly managing, owning hospitals within their geographical regions. Those regions will obviously be different depending on the groups. We've got some healthcare REITs, real estate investment trusts. And essentially, what this is where the REIT will own the hospital property, but then it'll be managed by a third party. Now, we see a lot of that in South Africa, where in the hotel space, where the actual physical buildings, the hotels are owned by a REIT and then a hotel company, whichever would then manage those buildings for them. Typically on a triple net lease, which means that the hotel group, rather than the REIT, is liable for all costs in terms of maintenance, rates, insurance to the building, etc., etc. The REIT is just responsible for providing the building. Equipment providers, and here we're talking big ticket items, and then protection, big ticket items, sort of CT scanners, MRIs, X-ray machines, etc. Protection, which is your PPE, medical supplies, which is drugs, and then your biotech sort of vaccines, and vaccines fit into the drugs, and we'll come into that in a little more detail. I want to delve into each of them. So hospital groups, I mean, there's two angles that are perhaps actually not going to be so excellent for hospital groups. One is that in the lead up to sort of the proliferation of COVID-19 cases, hospitals are actually seen markedly decreased occupancy levels. I spent a week over Easter in a hospital. My last night, I think there were 5 of us, an entire hospital of 80 or 100 beds. There's an analyst out of the US saying that actually hospitals are going to potentially lose 200 million US dollars on the back of lower occupancy levels. We've also seen that in updates coming out of the South African hospital groups, where those occupancy levels ahead of the sort of pandemic arriving have been incredibly low. And this is because people are largely staying away from hospitals, non-elective surgeries being cancelled, we're driving less, so less car accidents, we're outside less, so less violence and drinking, etc., etc. And then, of course, at some point, the sort of cases of COVID-19 curve goes exponential, and then they become completely overwhelmed. So they're going to go from very quiet to very overwhelmed, and the business of hospital groups, quite frankly, right now, I think is not that great. The REITs owning hospital properties, as I said, niche, solid business, relatively low risk, triple net leases, so they've usually got long-term arrangements, sort of 10-year locked-in processes. What I couldn't find was just a healthcare ETF focusing on the REITs only. You'd have to look at individual REITs. Healthcare equipment providers, these are the big ticket items. Again, we've seen updates in South Africa and out of the US where sales have actually slowed down or been cancelled. Some of the equipment is useful in the COVID-19 environment, but a lot of it is simply not. Now, some of this equipment providers is telemedicine and the like, and that was doing incredibly well. And I'm talking also telemedicine, I'm talking telesurgery, where you essentially buy equipment that can do surgery and you pay a lease and a royalty per use fee. But again, hospitals are scaling back in preparation. So a lot of activity in the equipment provider space has really gone down. The drug space obviously is going to be big. A lot more drugs when patients are hospitalized, a lot more treatment drugs, and ultimately perhaps a vaccine. the question there is who's winning, and that's perhaps the beauty of the ETF space, and we'll touch on it when I look at some of the ETFs, is that, is it the Gilead Sciences one that's going to be the winner? It's probably going to be a couple. So who's going to get the vaccine? Is it going to be a commercial vaccine? Quite possibly not. We saw that with HIV/AIDS drugs, ARVs, 15 or so years ago, where they became, they were still profitable, but the profit margins, were absolutely collapsed. I used to pay 15,000 Rand a month for treatment in South Africa. Now it's literally down to rands and cents. Protection, your PPE and the like, obviously unprecedented demand, because this is not only plugging into your frontline healthcare workers, but suddenly I have PPE in my house. I have masks and the like, which is something I never before had. Now some geographies, China most notably, polluted cities, they were more common. The problem is in this environment is that it really was, the demand is huge. We're struggling with audio. We lost it. It's back. I'm going to continue on. It's connection's not a heck lot I can do about that. If it really degrades, I'll go to a backup connection. We are, as always, recording. It'll be on our YouTube page within a couple of hours. The problem with production of PPE is that it was fairly low scale, apart from the N95 masks. But even in terms of how many were being produced, is that the production levels were minute. So what we're seeing is we're seeing fashion houses now producing PPE. So it's completely scattered. There was very little production of PPE actually happening in the States, and therefore in US listed. Some of them, 3M is the main provider of the N95 masks, but it's sort of scattered all over the place. And certainly demand is huge. We've seen prices rising, and in some cases rising incredibly strongly, but capturing it is perhaps proving difficult, in that there's no sort of key suppliers. It's just become scattered all over the place. And that's because prior to COVID-19, production was limited and really spread out, and most of it happening outside the borders of America. Biotech, into which vaccines could fall, it's risky. So your classic biotech is sort of researching into, Alzheimer's, cancer treatments and the like. And oftentimes it's a lot of upfront, but not necessarily any profit, because you might not find a working vaccine or a working drug. So is it profitable? International community is going to come along. If you are the company that finds a vaccine, how much are you going to be able to profit from that? Yeah, we're going to need 7 billion instances of that vaccine, and they're going to need to be delivered. But are you going to be able to, slap some IP onto it and charge accordingly? Simply, we don't know. My sense is that it's largely going to be non-profit. There are also in excess of 1,000 different processes out there right now, and we've got no idea who's going to come to the party with it. And I'm skeptical of the ultimate profitability of it. I think the argument's going to be quite simple. We're talking about saving human lives here, about opening economies. It's not about individual companies' profits, notwithstanding their intellectual property claims against it. So with that all in mind, on the JSE, which would be our online share trading, auto share invest platforms, we do have some medical stocks. We've got hospital groups, we've got some drug manufacturers, but we've got no ETF, and they're fairly, our hospital groups, Life, Mediclinic, Netcare. The first two have got offshore exposure as well as local drug manufacturers, main one obviously being Aspen. And what I think might well happen with the vaccine, because we're going to need 7 billion of them, is that companies such as Aspen, who have FDA approved production facilities in South Africa and other parts of their network around the world, is that it'll get contracted out. So, the likes of Aspen might pick up some, but again, I think it's going to be very, very low margin. And as I say, we have no healthcare ETF in South Africa. It's just too small a sector. So we flip over to New York, or the US, which you would need to transact on the Standard Bank Offshore platform, web trader. And by my count, New York Stock Exchange has some 55 healthcare. I was looking at healthcare ETFs. I was looking, so I did two searches. The one search was and it's the one on the right there, I basically just said, by size, by assets under management, how big are the various different ETFs available? And the chunky one, the healthcare sec selector, the XLV is the code, $24 billion. Dollars. I mean, that's chunky. Then next we've got the Vanguard at 10 billion, and the bottom one on the list is still 1.8 billion, and we call that dollars. These are giant size ETFs. What I also looked for was there a hospital REIT ETF? And that I couldn't find. Now, maybe it's just because I couldn't find it, but I was unable to find. But I thought let's delve into the five large ones here, because they're the obvious easy wins here. You will note they're either fairly broad healthcare or they're biotech. And biotech was for a long time the sort of hip and happening space and the key focus. The medical devices, we'll touch on it, but as I said, medical devices have been forever my preferred space because they're less open to regulatory issues. But I think under COVID-19, that has probably changed. So the iShares Nasdaq Biotechnology ETF, it's tracking the Nasdaq Biotechnology Index, US biotech and pharma stocks. So this is where we're going to see the spikes in drugs, in cures, in vaccines if they come out. Big holding, Gilead Sciences, we know their drug, which has been having some good tests and the like. A couple of others I know. Biogen's one that's popped up. Seattle Genetics is another one that I've seen around before. And really, these are fairly larger biotechs. There's a lot of the very, very small biotech stocks. They had a spectacular 2018. But as I said a slide or three ago, there's risks in the biotech space because typically it's a lot of cost and not necessarily any outcome. When you do hit and you find a cure for some highly populous disease, you do incredibly well. TER 0.47, dividend yield 0.27, code IBB. Dividend yields are typically fairly low. That makes perfect sense, particularly in a biotech space, but they're at this point burning through cash rather than generating huge profits. The Vanguard Healthcare Index Fund, this is an MSCI US investable market index. So it's large, mid-size, and also small cap. I like that large, mid, and small. There is some filters that they've put in place that don't get into too small and illiquid, but it does mean you're going to get the Johnson & Johnson, for example, United Health, Merck, Pfizer, Medtronic, who just had a fairly good run in the last couple of weeks as well. So you've got the sort of large stocks, and then you've got that long tail, which will give you the sort of more small, I suppose speculative is a fair word to throw it at. A chunky dividend yield, 2.1. That's obviously because of your big Merck's, Pfizer's, Johnson & Johnson. TER of 0.1, which is proper low, and share code VHT. This would probably be my preferred, but I'm going to come to some concerns perhaps in the last slide. But this would probably be, it's going to catch your broad healthcare. So this is going to, inside of here, you're going to have your traditional drug manufacturers. You're going to have some equipment. You're going to have hospital groups. You're going to have your PPE suppliers, etc., etc. The Healthcare Select, this is a SPIDER fund, includes stocks in the healthcare that are listed in the S&P 500. Again, if you look at that list, it's Johnson & Johnson's, it's United Health. I mean, the one point is compared to the previous, our list is pretty much exactly the same in the large holdings. Some difference at the tail, a slightly lower total expense ratio in the Vanguard and a slightly higher dividend yield. So otherwise broadly the same. The iShares Medical Devices. So this has been a ETF that I've long liked. Companies such as Stryker, such as Intuitive Surgical, Boston Scientific, and others. This is the equipment space. Now, I said that in the COVID environment, in the pandemic, we're seeing equipment suppliers anecdotally having a tougher time of it as big ticket items are being cancelled. Prior to that, I like this because one of my issues around healthcare as an investment strategy is that healthcare for individuals, the costs have been rising well ahead of inflation, and that's a global scenario. And I think governments are going to start pushing back. We've seen it in South Africa, single exit pricing for the pharmacies, proposed a national health initiative, but this has been a global phenomenon about the pushback. But the one space the pushback is not is the medical device space. So I've always said, if you want to get into healthcare, to me it's been medical devices rather, or I stay away. However, this I think is for non-pandemic times. In other words, come back to it in a couple of years when the pandemic is over. And in fact, we'll then see quite a spike because there'll be a backlog of orders and the like. 2.43, modestly to but high, dividend yield 0.03, code IHI. And then the Spider S&P Biotech ETF, literally the biotech segment of the S&P Total Market Index. It's pharmaceuticals, it's Amagen, it's those, United Therapeutics pops up again, really focusing on finding those next wonder drugs. 2.35, dividend yield 0.02%. And the reason is because many of these, if not most of these companies, are very much still focusing on finding those cures. There's a lot of cost up front. There's at this point, I mean, there's profits flowing, but there's not giant profits flowing in the levels that perhaps you would expect. So, as I say, my preferred is very much the traditional, the Vanguard healthcare under the pandemic scenario. TER of 0.1 is chunky cheap. Dividend yield of 2.1. The medical devices would normally be my preferred, but I think not under pandemic scenarios. But then some thoughts, and if you've got questions, I can see a couple popping in already. Some high total expense ratios, sort of none above 0.5, and that's why I say, but really we spoiled. I'm saying your expense ratio of 0.4, 0.47 is high, sure, but that's because we're living in a world of really low cost ETFs. Lower dividend yields in some cases, particularly biotech, this does make sense. But also in the US, dividend tax is higher than we see in South Africa. So a lot of companies favor stock buybacks rather than dividend because stock buybacks are tax neutral, whereas there's obviously a tax hit if you're paying the dividends. So they're making avoidment of that. Your niches within is focused on biotech or equipment. I got to say, I expected to find a lot more really, really niche health ETFs listed in the US, and I did find some of them. But market caps of $3 million, listed by companies by issuing houses I've literally never ever heard of. And I'm not going to put those out on a Standard Bank webcast. I mean, if you go to the etfdb.com, they list them. You can go and do your own digging. But the niche, the very small niche to me, it just brought a layer of risk I wasn't completely happy with. And a last point which I wanted to make, the idea that healthcare is a clear winner in the pandemic makes intuitive sense, but might not be certain. It might not happen. There are increased costs. Hospitals, for example, as I said, are deadly quiet right now. Terrible pun, are very quiet right now. And their expenses are through the roof in terms of PPE requirements. Suddenly receptionists and security and everyone else is laid out in personal protective equipment, whereas back in Jan, the only time you really saw PPE was in surgery and theatre, to a limited degree in ICU or high care units. The medical devices, things are being cancelled. The drug space, are you going to be able to get away with making a vast profit off curing the pandemic? Is there not going to potentially be a backlash? So just a word of caution. I'm not saying don't. I'm saying just, this is not necessarily an absolutely sure thing that we're looking at in this particular space. I'm seeing some questions come through. Drop me if you've got ideas for what you'd like to see in future Fridays when we're doing the ETFs, and also when we do our Wednesdays. We look at the website, and we're going to be doing derivatives going short, how to use websites for going short. Let me get to questions. Peter, you did find one. That's my bad. I didn't. So Peter has found, and I'm going to put it in for everybody else. He says, is a medical properties. MPW is the code. So medical properties are not going to, and I'll drop it in the chat. Thanks, Peter. I like the idea of medical properties. Of course, they're not going to be able to increase their rentals or anything like that. So in that sense there. Tebogo, can I trade offshore stocks in Viewpoint? No. So Viewpoint is JSE. If you want offshore, it's WebTrader. Just search WebTrader Standard Bank. You will find it. If you've got an OST account, the opening process is quite simple. And then it is just that simple to get stocks offshore, to get cash offshore. EJ, the tech companies in healthcare, maybe robots or high-tech screening. So there are some tech companies. There are in particular, so the tech companies are broadly in two fields, and I'm excluding medical equipment, which those medical equipment, particularly the newer equipment coming through, are tech orientated. The one space we saw of tech companies was basically telemedicine, where you are visiting your doctor online, and your health records are HIPAA compliant and stored online, etc. And we're seeing some activity there. The tech space that was very, very exciting to me, and has been doing great guns over sort of the recent sort of year and a half, maybe 2 years, is where actually they've taken AI, merged it with healthcare, and basically doing surgeries. So you are, for example, a hospital somewhere. You buy this machine, this equipment, you pay a monthly royalty, and then a patient comes in and they need a stent in a heart valve, or they need a cataract removed, or whatever the case is. And you essentially, as the hospital, you download the software package and you need an operator for it, and it then does the surgery for it. It is quicker, it is cheaper for both patient and for hospital, and it is has a lower error rate than a traditional surgeon. So it's a win all round. And what they do is, once they've installed their equipment, is they're constantly loading new procedures that can be performed. The problem is elective surgeries are out the window. So there are, and now the major company has completely left my head, which is awkward. The key challenge is that elective surgeries are down. There are some included in the larger ETFs. Kenneth, telcos. Yeah, let's look at some telco. That'll be fun. 5G, we'll look at telco. We'll look at telcos. We'll look at also equipment providers, and we'll look more broadly than just US. And then Shaman's also got one. So everyone has found the medical property investments, and I didn't. So Orbvest is another. Thank you. Luzani, do they have an IC-like platform for web trader? No, platform is a full function offshore platform. It includes, so it's offshore markets. It excludes South Africa. It includes FX and derivatives, as well as equity. So you've got, the 10,000 US listed. You've got a whole bunch FTSE and other European listed stocks as well. I can't remember the exact range now, but it's a giant in terms of markets and shares. It is tens of thousands of shares, and it's about 15 or 20 different markets. But it is a full function in terms of equity, derivative, and FX platform. And it is fully offshore. Standard Bank managed. If you've got a Standard Bank account, they can grab your FICA, but you fund it, and it will be funded in dollars, euros, or sterling. You physically move the cash offshore. Remember, folks, videos all go up onto the YouTube channel. The name for the YouTube channel is that horrible link at the bottom. So just hit YouTube, search Standard Online Share Trading. No bank, just Standard Online Share Trading, and you will find it. EJ, I will desperately try and remember the name of that company, and I will send you the details. If for nothing else, it is fascinating what they're doing. It's absolutely fascinating. I will get it to you over the weekend because I got a busy Friday, so I'm not going to promise today. In terms of what they're doing with the merging of, it's robotics, I suppose. It's not AI, it's robotics and healthcare. YouTube, search Standard Online Share Trading, and we'll find it there. Dividend tax in the US for ETFs. There is dividend tax. We can claim it back. We have a treaty with the US. We don't get all of it back. We end up effectively paying around 15%. Remember, the ETF issuers also take their total expense ratio fees out of the dividends, so dividends are a little depressed as well in the process. Ladies and gents, disclaimers, contact details, a few more questions coming through. Is the WebTrader App Store or website accessed? Its website. Webinar comparing costs of various international brokers in South Africa. SB. Stelos, I hear what you're saying. Standard Bank's not going to be happy if I'm rushing off. I'm going to ponder that. Let's have a dig around and see what we can do in that particular place. Ladies and gents, we'll park it there today. Everyone have a safe Friday going further and a weekend. This has been a 5-day week. This has been a weird experience. We haven't had that in a long time. It's taken a little bit of getting used to. We'll be back Monday, 10:30, with myself and Dineo looking at markets, weeks that was and weeks that are coming up. Everyone have a great day further. Cheers all.